This episode is proudly sponsored by ShakePay, Canada's easiest way to buy and earn Bitcoin in 10 minutes or less with no deposit or withdrawal fees. It's so easy, even the boomer can do it. Guys, I've personally been using ShakePay for several years and highly recommend them. Their mobile app makes it super easy to buy and sell Bitcoin. All you have to do is e-transfer directly to your ShakePay account and you're ready to go. So head over to shakepay.com or download the mobile app, use the referral code Loonie Hour and get $30 of free Bitcoin when you sign up. ShakePay gives out free Bitcoin to every user every day just by shaking your phone. They call this the shaking sats feature. It's awesome. I highly encourage you to go check it out. ShakePay has also just launched one of Canada's only Bitcoin cashback prepaid credit cards, which gives users up to 2% Bitcoin cash back on every transaction. If you want to opt out of Canadian dollars and start earning rewards through Bitcoin, go check out ShakePay. Once again, guys, that's shakepay.com. Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to the Loonie Hour, episode 43. We've got the three amigos, as always. We've got Rich Diaz, the Tom Brady of macro, the pride of Montreal, and Keith Dicker of IceCap Asset Management. Welcome back to the show, gentlemen. What's new? Rich, you made it safe and sound in Montreal.
Safe and sound. Drove through the eastern part of New Brunswick. If you need a job, I know where you can find one. It's actually a weirdly beautiful place. And I say weirdly beautiful because there's lots of RVs, and I shouldn't hate on people RVs. Some of them, they're very, very expensive, some of them, but it's just like it's a mix between just gorgeous old homes from like 100 years ago. Then right next door is like an RV, and then right next door to that is a beautiful just beach that goes on for miles and miles and miles. And I would definitely recommend anybody to drive up that part of the world. Everyone's really, really nice. It's cheap to live there, and there's jobs aplenty. So yeah, that's my travel advice for the week.
You know what I've always found interesting is like, you're driving through like whatever, like rural New Brunswick, and the fact that we have just in general, we have like one CPI inflation basket for all of Canada, because you're like, what is the inflation rate in rural New Brunswick versus like the metropolitan downtown core of Toronto? Like, you know what I mean? Like, you're seeing obviously, over the past 5 to 10 years, the rampant increase in house prices and rents and everything in the major cities, and obviously, a lot of stagnant areas in parts of Canada where there's very little growth. But alas,
I wouldn't say this is a stagnant part. I mean, it's clean. It's, I made a joke about the RVs. RVs are not cheap things to buy and own and operate. These homes are beautifully situated. The lawns are manicured. It's a really I know it's not, Côte d'Azur or the Amalfi Coast here, but it's a really, really lovely place to hang out. And like I said, everybody there I met was lovely, and they all tolerated my interrogations about the local economy. So
like, who is this guy?
Did you come up with any new pickup lines?
No pickup lines. I tried a couple. They were not impressed by the impossible trinity or financial repression. So
speaking of financial repression, you had a really good chart on Twitter, because people were giving me a hard time about the whole financial repression. We'll throw it up here, but it was that Canada's, despite the BOC's, rampant interest rate hikes here, that we're still we're still running real negative rates in Canada of what are we running at? Negative 5%.
Yeah, let's just say between 4 and 5. There are different ways to calculate it. And somebody on Twitter actually had a really good response or counter, which is if you use the market priced real interest rate, that we're quite a bit lower. So how do you calculate that? There's things called TIPS, which is a Treasury inflation protected security. I think that's what it sounds like. And you can use market based real interest rate pricing. So basically bonds that pay you for inflation And you can use that as your proxy for real interest rates. And someone correctly pointed out that, my methodology was sort of backward looking. And, I said, well, listen, there's loads of different permutations but all this to say is that, so depending on what you're looking at, whether it's the one that I use, which is core inflation versus, a 5-year bond, or if you're looking at the gentleman's suggestion, which is to use the market-based real interest rate, they're negative. You know what I mean? It's still, in theory, you still get paid to borrow. And I just think that's back to your point. That is what financial repression that's one of the tenets of financial repression. I don't know, Steve.
Well, yeah, I mean, speaking of getting paid to borrow, good way to start the show up here with the latest figures from the, large parts of the Canadian housing market. So I'll start it off here in Vancouver. I think we chatted about this briefly. I kind of alluded to what the outcome was going to look like. But Greater Vancouver home sales, 22-year low. So 22-year low, fewest number of home sales in July. You'd have to go back to July of 2000 to actually beat this number. So kind of put things into context, especially when you start adjusting for the fact that, these numbers aren't adjusting for the growth in population. They're not adjusting for the growth in housing stock. So to see that, and then, you flip it over and go to the other large metro in Canada. I really say, like, Canada, I think ultimately still has two housing markets, Vancouver and Toronto. Those are what set policy, I think, federally. Toronto, I think it was the 4th month now in a row where they've had 20-year low in home sales. So, I mean, it's really just what's happened here is you just have a very illiquid housing market. I mean, to suggest that, I have to laugh when, the BOC comes out and says, well, the housing market is going through a rebalancing. I mean, I just don't think, 20-year lows in housing activity is like a rebalancing. I think that's something much more than that. But yeah, we'll see. Obviously, we're going to get to find out here, I think, in the next 3 to 6 months, how much pain central bankers are willing to tolerate. I think that's going to be sort of the theme of this week's show, which we'll get into in a little bit. But quick note on Toronto as well. So the home price index in Toronto declined 3.9% in July from a month earlier. So basically, a 4% move in the home price index is really unprecedented. It's actually the they've posted the worst 4-month decline since 2005. So the home price index was actually created in 2005. So of all the data that we have since we started accumulating these home price indexes since it was created, it is the single largest 4-month decline in that area. So again, just to kind of summarize, you've got 20 plus year lows in home sales. You've got the worst declines that we've ever seen on record since that index was created. I think this is just showing that this is not a rebalancing. And so long as mortgage rates stay where they're at, around the 5% range, I think there's more pain to come. And so really the crux of the conversation continues to be how sticky is inflation going to be, number one. And number two, are central bankers going to have to basically deviate to some degree away from their inflation targeting and start focusing on the economic ramifications of their interest rate hikes, which is how much pain are they willing to accept going into a recession? How deep of a recession will they tolerate before they have to pivot? And they might just have to pivot with inflation still at 6.5% or whatever. And that's certainly what the market is pricing in. In the bond market. Rich, I don't know, or Keith, I don't know if either of you want to chime in there from what you're seeing. Obviously, the 210s inversion, getting steeper and steeper here. So,
well, yeah, I'll just go one out of the curve. But what's expected right now for the Bank of Canada and the Fed? So they're lockstep now. They're both at 2.5%. We have the Bank of Canada coming up on September 7th. So it's not, about a month out, the dog days of summer, right? Of August, in the baseball analogy. But they're both expected right now to be at 3.5% at year end. So I know last week we were talking about, what path is the Bank of Canada going to take? So right now it's really pricing in 50 for September, and then either another 50 in October and then nothing. or a 50 and then, 2 quarters going through. And we'll talk about why that's coming off as well. And the Fed is the same way. So
I believe they were at 3.75 market expectations like a couple of weeks ago, even. So they've shaved off a little bit of rate hikes.
Yeah, right now the Fed is expected to be at like right now 3.25 to 3.5. That's what's being priced in the market. Because what was really interesting with the Fed it was last week, right? I think the Fed,
yeah,
when they were out, yeah. It could have been interpreted that they were going to do their pivot that we've talked about, and the market said, hey, they're now going to turn dovish, they won't raise rates enough and stuff like that. And that's what the market went with, the narrative, or what the media will tell you. That's what happened. I mean, you never really know why capital is moving in markets, one market to another. The media always have to come up with a reason why it's happening, and it might be right or wrong. You never know, but it gives us something to talk about. But what I always like to see happen is after a Fed meeting or a central bank meeting of any kind, usually in the next few days afterwards, you're getting members of that central bank that they're talking. They're either at a university talking, or at the Buffalo Club, in
The
upstate
Goldman
New
Sachs
York,
lunch.
the Goldman Sachs elevator, and stuff like that. And that's where they get to set things straight. So Powell and the Fed said one thing, and the market reacted one way. And all of a sudden, the Fed is saying, "Oh, that's not the way we wanted you to react." So over the last couple of days, especially in the U.S. with the Fed members have been very aggressive. They're saying, "Hey, I think the market." They're saying the market has got it this wrong, in that we are still very hawkish. We're still going to raise rates. We think inflation is going to be high, and we're going to keep raising rates, and then inflation comes down. They didn't mention anything about growth or slowing growth or recession or employment or any of that. They really want to get away from that recession conversation, and instead of just they had to sort of steer the ship. So again, I remember some guy reached out to me yesterday, and he said, like, was the Fed trying to you use the term moral suasion sometimes. It's an academic term. The central banks can sometimes guide the market without doing anything. And I said, well, it's not really moral suasion at this point. What they want to do is make sure the market, and when they say the market, they're really referring to overnight money markets, right? Money rates, because they want to make sure the commercial banks especially are always on side and they don't get caught by surprise, because it does no one any good for a pretty significant commercial bank to be on the wrong side of the ledger at the end of the day, with overnight rates. You go to the repo market, you name it. So I think this week was really the Fed saying to commercial banks, guys, we're going to keep hiking. So, maybe I think the central banks, so they will continue on that path to the 3.5% mark, or maybe higher. Unless, and here's the caveat, of course, unless something happens to prevent them from going there, which really maybe
China invades Taiwan.
Well, we need to talk about
kidding,
that, of
I'm
course,
kidding, I'm
right?
kidding.
But anything, it could be an economic event or geopolitical event. It could be anything. But again, on my desk over the last few days, it is a pretty big event to see the Fed speakers come out and say this, and it's had zero effect on the market. Like, the market is now back risk on again. We've had a couple of pieces of economic data points came out, and you push them together. They're saying, like, hey, growth is slowing, but it wasn't slowing enough to say, hey, recession is coming, it's going to be big. Because I think, like, our view is that the probability of the economy slamming the brakes, we think it's a lot higher than the market is expecting. So, and I think the data will really start coming out for July data as well as August. So we'll start to see that in early mid-September when it's coming out. But that's it. Speaking of recession talk, we had the Bank of England this morning. You guys want to talk about I call them the Brits.
50 basis
I call them the
points.
Brits. I got a lot of great friends over there. I just call them the Brits, and that's it. But Steve, what did you see on the Bank of England there this morning?
Yeah, I was just watching it briefly before we jump on this call, but 50 basis points from the Bank of England. The Bloomberg reporter basically asked, hey, the market thinks you're going to get to 3% this year. Is this kind of where you think you guys will get? And he basically, didn't have an answer, didn't want to give an answer. Just basically was highlighting the uncertainty of everything. So I think it's kind of just, we talked about it a little bit before, we'll talk about it again, but basically it seems like every central banker right now is kind of on the same, it's almost like they've been given the same script, right? The same script, which is, hey, listen, there's no more forward guidance. We're very uncertain about the path forward. We're trying to sort of front load our rate hikes, but the next moves will be sort of data dependent. That's basically what every central bank is now telling you. And so again, the markets are trying to sort of interpret what is data dependent, right? Is that how much does inflation need to come down, and how much are central banks now starting to look at the economic data, which is, I think, quite clearly, deteriorating. I think we're seeing more and more companies talking about pausing hiring, job layoffs. I think there was, Walmart this week laying off, a couple hundred corporate employees. You had Credit Suisse talking about getting rid of a whole bunch of people. Just more and more coming out of the woodwork. So, I mean, Rich, I don't know if you have any commentary on any of that, or the economic data that you might be looking at, or that you think central banks might be, maybe looking at, or potentially even missing in the months ahead.
Well, I wouldn't presume to know what the central banks are missing. The list is probably way too long. But I will say the job stuff I thought was really interesting. One of the indicators that we tend to look at is something called the JOLTS. I'm going to screw this up. It's basically a labor market survey. I can't remember the acronym. Sorry.
I'll try to Google it for you while you're here.
I should know that. That's really bad on me. Anyways, so
job
basically, the
opening.
JOLTS, there we go.
Job openings and labor turnover survey.
Thank you. Sorry. So it's a job opening and labor market survey.
There's your next pickup line.
Yeah, that's my next pickup line. Anyway, and that was actually, it came off, and I think people were saying, you see, we told you the labor market's getting weaker and getting weaker. And yes, I think at the margin, it's definitely getting weaker. I think what sort of the headlines forgot to mention, that there's still in the US, still 1.8, 1.9 job openings for people basically unemployed. And so, and I think that these vacancy rates, again, I get in trouble for talking about labor shortages a lot on Twitter, because everybody's just like, oh, pay more wages. It's not that simple. And it's something that maybe we'll discuss more and more as the recession starts, or who knows what the recession.
Oh, there you used it.
No, I didn't even use the R word, but as people talk about more weakness in the economy, the JOLTS data came out, and it came lower than expected, and it's starting to roll over. But context is everything. It's rolling over at basically an all-time high. There are still, I think, 10.8 million job openings in America. There's 1.3 million job openings in the UK, I believe. It's obviously a smaller economy, so there's less number there. If you look at labor shortages in Canada, the surveys continue to be extremely, extremely high. And so, in this, I think what we're about to see, I'm just fleshing this idea out, so forgive me, boys, but, in 2008, we saw sort of a recovery in profits and no recovery in jobs. And I wonder that maybe we'll start to see sort of, maybe this is optimistic, but forgive me, it's the summer and I'm an optimist, but we might see a situation where you have negative earnings growth over the next little while, and actually the labor market, holds up okay. Again, there will obviously be layoffs in some sectors, et cetera, but the shortages, the structural lack of warm bodies is, I think, something that will be supportive for the economy. And I think it's going to be hard to kind of reconcile that with the clear slowing in economic activity. And it's just something that was, I think, a really important data point to keep an eye on going forward, is that JOLTS number and the employment number that's going to come out, I think, tomorrow, right? The first Friday of every month is the non-farm payrolls. So we'll see.
Yeah.
So something to keep an eye on tomorrow if you guys want to, after this comes out, unfortunately.
So because we recorded this on Thursday, right? So it comes out on
Bingo.
I want to jump back to what the Bank of England commented on, and you guys just had 10-minute opportunity. It was the biggest single event out of the Bank of England this morning. So not only did they raise rates, by the most, they've raised rates by before, and but they've also said, hey, we're going to go into a deep recession in Q4. Which
they said that?
Yes,
Yeah, they did.
and it's
They
it's
did, yeah.
unbelievable
Yeah.
for a central bank to
To say that.
the R is, I know Rich is afraid to say it, right? Recession, recession, it's coming.
Did he
But
just step
It's
out of line?
already
What's that?
here.
What's that guy's? What's the BOE guy's name again?
Oh no, I can't remember.
I don't know who's head of the BOE now. However,
Some
but the
putz,
point
eh?
is, the Fed will, they don't like to use the R word. The Canadians don't like to use it.
This guy blew it.
The Japanese just say, well, that's what we've always had. So they don't, they just call it the economy over there. But to make it even, more serious, again, the probability of something coming up. So either the Brits are incredibly wrong to say that. Remember, they said it. It's not a reporter or an analyst.
Right.
This is the Bank of England, right? It's the old lady. That's what the central bank is called over
Andrew Bailey, that's his name.
Boom.
I remember.
there. Bailey, yeah. And
Good work, Bailey.
way to go. The lads on Threadneedle Street. And but so either the Bank of England are the only guys with the the truthiness that's coming out, and everyone else is wrong, or the Bank of England will have to do like the Trichet move that we talked about in the last week's episode. So again, like, read up on this. So we have the Bank of England saying, hey, we're raising rates aggressively. We think inflation is going to reach, I think they said, was it 9 or 13%? I forget the number they came
13.
out with.
13.
They're saying, tell everyone, listen, prices are going to continue to go up. And by the way, you might lose your job as well, but we're going to raise rates. And so again, I think as we get into the fall, we could start to see more signs. And one sign of that just came out of China this week, they actually lowered the reserve requirements for their commercial banks. That means that's providing liquidity into the system. And I think the Chinese are in a lot of trouble economically. And we got to jump over to Taiwan as well with that. But that's the big point with the Bank of England.
I want to ask you a question, Keith. I want to ask you a question. So what do you think? I'm going to ask you to presume what the Bank of England is thinking. But if they're so convinced we're in a deep recession, that's the language they use, by the way, they use deep recession. And why bother raising rates? Why not just like hold out? Why not just like keep rates at whatever they were? I think it was 125. Because in a recession, you're going to have demand destruction. And even in this stupid scenario where natural gas prices are 10x what they are in the US, you will have inflation come off sort of quote unquote naturally. So what do you think is their rationale behind that?
I don't know. I mean,
okay.
Yeah. I mean, this sounds a bit flippant, right? But when we're managing money, like we never say, that the Fed should do this or the Bank of Canada should do that. We say, this is what they're doing. This is, and I've always had the stance that most central banks, they're very clear in communicating where they're going. And sometimes they'll trip up with it, right? So for example, again, I just circle back to the Fed. In their mind, the next day they said, wow, the markets didn't hear us correctly, so let's try to right this ship again. So for whatever reason, the Bank of England, they raised rates because of the whole inflation story. And again, it's irrelevant whether I believe that will solve the inflation story. I don't think that's going to help, produce more nat gas or oil for them. I don't. Maybe I'm dumb. I might be dumb, but I'm not stupid, right? But again, that's what they're doing. And you're right. The biggest way to cure this inflation problem, and we've talked about this before as well. Now,
you got that right. I got
you
that
create two things, like a slowdown, or say it, Rich. Say it. Come on. Recession. Yeah. Or you have financial markets. The wealth effect becomes negative. That's what the Americans have been doing. And I think we all agree as well that the inflation numbers, that they should start to roll over here, pretty soon. But this is what the Brits have done, and they said, by the way, the recession is coming. And it's like, so all the guys that are sort of calling for a recession now, like, they're not looking at the most recent data. Like, they will look at like a 6-month rolling average, like compare that like to the peak, and things like that. But there's a lot of data out there to suggest that if it's not going to be a recession, it's going to be a slowdown. And then you have to adjust it. So by the way, so with the Canadian banks, we have RBC will come out with earnings on, I think it's August 21st, 23rd, something like that.
You're already
August
starting to see the
24th.
mortgage lending. I mean, the thing that Steve didn't mention and relates to Keith's point while he looks up the date, which is the mortgage lending is, I mean, if you have house prices going down or negative month on month because mortgage lending has slowed, and that's obviously going to affect Keith's point about bank earnings. Keith, when are they coming out? Sorry.
August 24th for RBC. But the big thing that I'm looking forward with Canadian banks earnings now in a few weeks is with their loan provisioning. That's what we would call it. It doesn't mean you're writing off the loan. You're making an allowance for probable bad loans coming up. And this is what I'm looking for, to see movement in this. And all that, they should all be increasing their provisioning. And if one doesn't and all the rest do, then you're like, okay, what are these guys trying to hide? Because they're all lending the same markets. Like, bank one versus two or three, none of them are any better than the other at a product they're selling, because they all have, it's all homogenous and whatever. They all have a market share going around. But again, like, I just circle it back that we are entering this cycle where growth could surprise everyone.
It's interesting.
Except the east coast of New Brunswick, because that place is booming.
Booming.
It's really nice.
We should do our next Loonie Hour live event there at the trailer park.
No, don't be mean.
I'm serious. Get the RV. We'll do a convoy through Canada.
Things are freaking expensive, by the way. They're like hundreds and hundreds of thousands of dollars. Something.
We'll be like the next convoy treading through Canada.
There's one of those.
I love that. By the way,
not the trucker convoys, the Loonie
Hour convoy. We're gonna talk.
There's one of those camper vans, the Mercedes, the Sprinter, I think it is. Camper vans. In and around the block, and like it hasn't left the driveway for 3 years, say. And I walk every time Mrs. Icecap and I walk around. I said, "That's what I want. That one there." And every time she says, "You realize I'm not going with you." Like zero interest in that. So,
we'll go with you.
Just make sure
even you. We'll drive around.
Hey, just make sure you fill out your ArriveCan app.
That's right.
What is that? Is that popular app everyone's talking about?
Oh yeah, 4.5 rating.
Yeah,
it's very popular.
So Rich has an interesting story. It
wasn't mine. I double checked something I read on the internet. Apparently, not everything you read on the internet is true, which is I didn't know that. But it's got 500,000 reviews, and it's got a 4.5 rating. And I double checked, and indeed, it has more than Uber and Tinder and all kinds of very globally, I should say, popular apps. It has more reviews than all of those combined, and it's a 4.5. So hey, all this criticism of ArriveCan cannot be true because it's got a great rating on Apple.
What are the odds? Did you say Uber had like 100,000 reviews, ratings, and somehow ArriveCan has 5 times the amount of reviews?
Anyways, it's just such a joke.
At least we're doing something right in Canada.
Yeah, that's right. We're
great success.
Who said our tech sector isn't booming? There you go.
Keith still doesn't know how to fill it as ArriveCan. But yeah,
Keith doesn't get too excited about things because I'm skeptical about a lot of things, and I expect this. I'm just happy to see the young guys here
the wool finally being pulled.
Finally understand that maybe things are not exactly as they're telling you should be thinking.
Indeed.
Sound like a central banker. No, I mean, so the Bank of England, yes, has in fact going back to reading some of their comments here. Just to summarize these guys up. So they are calling for peak inflation of 13.3% in October amid a surge in gas prices that will sharpen a cost of living crisis that will see real disposable incomes fall more than any time in around 60 years. And they're saying that the recession will last well into next year. So they're actually calling for like a prolonged recession in England. So they're not really mincing words, I suppose. So I mean, I guess I don't know. This is not maybe a Twinkie bet, but just a general hypothesis here is like, how much are they willing to sacrifice the economy? Like, it's like, you know what I mean? Like how many job layoffs do they need to see to be happy?
Well, so I'm going to just, I mean, but this is the
Because
problem.
like, you know what I mean? Like you raise
go ahead.
rates. So inflation comes down from 13 to 8, 7, 6%. Like, and you know, your unemployment jumps, I don't know, significantly. Like, is that, are we better off?
That's the point with all this trouble of using inflation to fight. Using interest rates to fight inflation that comes from, especially in the UK. It's not so much in Canada, but especially in the UK, from energy prices. And oh my goodness, it's my fault. Oh, I screwed up. Sorry.
So is this? Yeah, I mean, is this not like we lost Rich?
Where did they go?
My phone rang. Sorry. My phone rang. I owe money to the kitty. I'm sorry, but yeah. So this is the problem when you use interest rates to try to fight inflation that comes from side issues, which is basically energy. I don't think it's going to affect that at all. I don't know.
Well, they literally mentioned that in their speech. They said
Right.
inflation is going to hit 13 because of Russia, Putin. Obviously, the Putin price hike. They're calling it.
It's pretty soon. It might be the Pelosi price hike.
Oh,
Huh?
did you see that? Did you see that meme?
Have you noticed I can make myself laugh? It's
Pelosi
pretty cool.
behind enemy lines.
There's.
I mean,
let's start before we cross the Pacific.
the Rubicon.
But it ties into your question, Steve. So now every major central bank that we're following, except for the ECB and the BOJ, which are two big ones, but the Canadians, the Americans, and now the Brits, they're telling us they don't care about the economy and employment. They just want inflation to come down, and they're going to continue to raise rates until it comes down. So that's the view that we should have. If you have a different view, it's unacceptable.
This is shaping up to be, I think, a real crap sandwich, and everybody's gonna have to take a bite here.
It's funny though, because in the last 2 months, the markets are up 10%. So it's fascinating. Again, we talked about it last week, with just this like back and forth between like sort of everyone consolidating around the R word, recession, and yet the markets are just like not having any of it. We talked about trying to figure out explanations for why things are happening. I'm guilty of trying to do that all the time, of course, ex post. And, for me, it's just about this. It's this real rates. This real rates have propped up markets, propped up valuations. We'll share the chart on the YouTube. But it's basically, I mean, we talked about it before we got on. Is the Fed put back on? I mean, is the market starting to call the Fed's bluff? And so for people who may not understand that, it's just like, will the Fed pivot away from this fight against inflation? And so far, Keith doesn't believe so. I don't necessarily believe so either. But the market is sort of on the other side of that, and that's why I think equity markets have rallied, and that's why valuations have rallied, despite the fact that there's been no earnings, and earnings have actually disappointed in many sectors. So I don't know.
July was also, I mean, hindsight works pretty good sometimes, and like the rally in July was pretty nice, for equities, for credit, duration. Commodities didn't do that well, really, but it happened, and people say, well, why did that happen? And we've talked before, you don't reconcile the economy with the stock market, because they're never reconciled. But the markets were just so oversold on the currency side, as well as equities and the fixed income side, that, this bounce, it shouldn't be unexpected. People say, well, how come you didn't say that back in June? Because maybe it would happen in September, right? You just don't know when it's going to happen. But nothing has really changed with the narratives that we're on. Instead of people that made a lot of money on the short side of whichever market you want to choose, they've made it. And now they've covered a lot, and now markets are getting back in equilibrium a little bit. And then we'll say, hey, where are we going to go from here? And like I said, like August is usually, a sleepy month. We have one more data point coming up for the non-farm payrolls, and then we go back to summer. What's your favorite summer story when you were a kid, Rich?
Oh my goodness!
Holy Trinity.
Well, we should just play ball hockey day and night on the street. I never see kids playing ball hockey on the streets anymore, which is a real shame. But we used to just play all day long, and we'd come back and our hands would be black and
A true Canadian
dirt,
boy.
and we'd just be playing street hockey down in Westmount, Montreal, and just all day long. And then we'd only stop for lunch for 5 minutes and then head right back out. We'd all be yelling the proverbial car and moving the net, and no one wanted to play goaltender. And but yeah, I guess that's my favorite.
Strap Keith in that.
Yeah, I was the kid they stuck in, right? And but it is a good example. Like summer is coming here now. People are doing their summer stuff, and that is happening. So we should get some downtime, unless
Is that why the housing market's so slow?
Is the housing market seasonal? That's a dumb question.
No,
Okay,
so it definitely is seasonal. Like the summer months are always very slow, or like quite slow.
Okay.
I mean, other than the pandemic years, because like nobody was
No,
traveling.
forget that. I mean, in general.
In general, yes, summer is a slow time for real estate. It's actually typically a good time to buy real estate because there's really not a lot of competition, and there's not a lot of buyers actively looking, right? They're all on vacation. So yeah, but I mean, that's why we always do and say, okay, well, let's compare, July versus all the other Julys and look at how we were performing. And that's obviously the one thing I found kind of interesting on the Canadian banking side is that we've seen this move in the Canada 5-year government bond yield, right? So it came off about 100 basis points. It's now up, they're 20. So whatever, we're off 80 basis points from the highs. What's interestingly enough is almost all of the big Canadian banks have actually not moved their fixed rate mortgages at all.
Can't see that.
I think one of them moved. So again, imagine this. The 5-year yield, which prices these mortgages, essentially came off 100 basis points. One bank, I believe, dropped rates by 5 basis points. So I'm kind of wondering, in this sort of somewhat a liquid market, how much these banks are pricing in that premium, right? Of like, hey, listen, like we're risk off here. We're worried about the market. We ain't cutting rates. There's too much volatility in bond markets, et cetera, et cetera. I don't know, Keith, how much stock and weight you put into that.
It's the word ritual. Say out loud. Well, that's what. So to be serious about it, I mean, so commercial banks, they're not lowering rates because really the credit spread has widened.
Well, I mean, if you look at the U.S. mortgage rates, they actually have dropped quite a bit. So the U.S. banks seem to be passing on, the discounting in interest rates.
Yeah, but the U.S. mortgage market's housing market's
deep.
very different than the Canadian market. But again, like for what it's worth, it just tells me that the Canadian banks are not willing to lend, even though the 5-year government rate has come down, because that's come down. The commercial banks that kept the mortgage at the same level. It means the credit spread has widened, and that's what happens when Rich, say it.
That's when you get a recession.
I know it's getting old, guys, but I'm just
no, it's still
when
funny.
it happens. I don't want anyone to say, "Wow, no one knew this was coming." So anyway, there we are.
Well, there's some other data in Canada that I want to talk about if we can. But
okay, sure. And I've got some questions afterwards, but
okay,
some deep questions. But Rich,
well, I just want to talk about my favorite subject because we haven't talked about that in a while, and we got new data out. Basically for the Canadian for trade data came out.
Oh, I thought you were going to talk about ESG.
Oh no, I don't want to talk about ESG. ESG is such a freaking lie. Anyway, so we got some new data out. Obviously, it was this net export data, and in case anybody's keeping track at home, Canada's energy exports continue to prop up our current account balance, so that hasn't changed. But what it was interesting is the total exports, net exports, ex energy sort of remain quite weak. But there are some positive things. Like if you look at services ex travel, so travel basically is an export if people come to your country, and it's an import if you go away. So that just so people understand. And then again, so it's incredible. So the net exports of, of energy products just continues to go higher and higher, obviously because of volume, but also because of value. Oil prices are still quite high, even at $90 a barrel, $90 US a barrel. And so I thought it was really positive. But there is definitely some weakness sort of in other parts. I mean, you have, one thing that Canada used to do a lot of, which is export motor vehicles and parts. I mean, that is basically at now an all-time low according to this series. So there's still, it's just to remind everybody at home how important crude oil is to our economy, sort of, and why. When I've been trying to convince my mother for months now to buy euros, she's about to go to Europe on vacation, and it's just, tells you why, the Canadian dollar is not all-time highs, but I think 7 or 8 year highs versus the pound and the euro, et cetera, et cetera. But yeah, so okay data on the trade front. So that was me. That's all I wanted to say. I needed to hammer that home a little bit.
Did you know that the EU is going to exempt private and corporate jets from the green aviation fuel tax?
Is that real?
That's real. Remember, we're all in this together.
Such a joke.
It's not fair.
Sorry, Keith. Or no, Keith's PJ is exempt. But so my question really is, speaking of oil and gas here in Canada, correct me if I'm wrong, with gas prices are down. They're down for what, 40 straight days now in a row?
Yeah,
I know we're coming off very elevated levels, but I'm just looking at some of these commodity prices, right? I mean, I'm building a property right now in Calgary. I mean, lumber prices have done a round trip. They're back to pre-pandemic levels. So, I mean, obviously, it's lumber. We're not talking about, oil and gas here, but it seems all commodities are getting hit. You've got falling bond yields. Obviously the markets are basically pricing that recession. I mean, what's the biggest thing that you look towards here? I mean, like, you've got the 2s10s inversion. To me, it just feels like inflation. I think this is me. I'm not the smartest guy by any stretch, but is going to come off, I think, a lot quicker or harder than I think a lot of people are anticipating, or maybe central banks are anticipating.
Well, I mean, I'll let Keith handle that second bit, but I'll just take the first bit, which is the commodity stuff. I mean, I look at like industrial metals, which are off, 30%. So what are industrial metals? They're platinum, palladium, copper, tin, nickel, zinc. I'm not sure zinc is a metal, but anyways, aluminum, all that stuff, they're all way off. And then you could say partly that's a function of the China story. Definitely, they're a huge consumer, but it's the growth story. It's the R word that I refuse to say. It's, people are just so that I think that that's really important, but we are still quite a bit higher than the 5-year average, which is what I tried to look at. And I think going forward, I just I submit that there just has not been anywhere near enough capex for sort of the next cycle. So eventually after the recession, things hopefully will heal and then growth will kick off again, as cycles do. But the capex, the capital expenditure on exploration, processing, refining, et cetera, that you need to bring those metals and oil and fossil fuels to market, it just hasn't been anywhere near enough of it. And so although I think that the metals have fallen for the right reason, which is worries about growth, I would argue that the floor is much, much higher, I think, than people might be willing to admit or anticipate. And it's just something to keep an eye on going forward. I don't know, Keith, if you wanted to add to the last part of it.
No, I see it the same way. I mean, we talked about that whiplash boomerang effect that might come up soon with the economy. So again, if we do get economic slowdown, commodities will sell off. And I know for us, we're expecting, and I hate to use this word, but we're hoping it happens. No, hope is never a good strategy, right?
No,
I hope this works, but if this is the way, if it plays out on the path that we expect it will result in lower commodity prices, but we would see that as a temporary period.
Good entry
point.
Yeah,
like, so whether it's, a few hours or a couple of months or a couple of quarters, you don't quite know yet. But remember, we just had this euphoria going on in the commodity market, especially oil. I mean, oil right now, West Texas is at like $88 here this morning. Wasn't it like at 104, 105 just, a couple of days ago? And like at our target price for oil, like we could, we could be by $70, down by Monday or Tuesday even, unless, something else happens outside of, the regular economy. But I agree with Rich on the way that's moving.
But I mean, like
One
the narrative from like so many market participants was like, oh, it's oil is $100. When it was 100, everyone's like, oh my god, it's going to go to 150 and then to 200.
It's always like that,
And it's like, oh well, yeah, it might go to 70 or $60 here. Like, I don't know.
That's the channel. I mean, everyone has linear thinking, and the world doesn't work that way. Markets don't work that way. Everything will run on a cycle. That's the way it's going to go. And so expecting like oil goes from, like, remember it went negative there a couple of years ago, and by definition, what would it touch? Minus 25? I don't know what it was on
crazy.
that day, right? And by the way, that's just a settlement problem they had in the futures market. That's what it was. It was like the hot potato. You couldn't get caught with it. But by using that definition, oil will be at minus 200. And obviously that didn't happen. And, maybe it does go to 200. I'm sure at some point we might get there, or maybe we won't. Or maybe if all of these climate change policies are really enacted around the world, and that will drive the price of oil up. But by the way, we need to talk about the whole fertilizer Netherlands story, which has gone to the next level.
Of commodities in general. I mean, I'm just reading something here today that the Dutch government, we've talked about the Dutch from the show before. It says cows, pigs, and chickens help to make the Netherlands an agricultural powerhouse, but they also generate alarming levels of nitrogen emissions from their waste. The Dutch government has a drastic solution for the problem, and it's to cut livestock numbers by a third.
You will eat bugs and like it.
It's like I don't know, man. It's like you kind of you keep reading like all these like articles and news stories, and it's like this whole like World Economic Forum 2030 like agenda. It's so like conspiratorial, but then it's like it's actually like there, and it's like you're seeing like governments actually enact like policies.
I mean, conspiracy theories are dumb, so I will not entertain that. What I think is, never ascribe malice that something could be better explained by stupidity. I think it's Harlan's razor. I think that these people are just dumb. I think that they think that if they stop producing these goods, that people will stop eating chicken, pigs, steak, etc. And it's just not going to happen. It's going to be exported to a country that gives a little less of a shit about the environment, just like our manufacturing of and refining of fossil fuels in the form of plastics or rare earth metals that are processed in China. Rare earth metals that is used in basically every single electronic good that you have is extremely, extremely dangerous and nasty to process and make into usable material. And the reason Canada, for example, no longer does it is because they can do it more cheaply with caring less about the environment and less about your labor market in China. So now China, for example, dominates that market. So the idea that the Dutch government are going to save the world, or the Canadian government is going to save the world by restricting the growing of and processing of these animals for us to consume is stupid. It'll just be moved to a different country that does not care about the environment and cares more about growth, productivity, and efficiency. And so that's why I'm sorry to push back so hard on the conspiracy theory thing. I think if these people just they can't, they're just not that smart. They just don't think about the world in a holistic world thing. I think that they're obsessed. I mean, in some ways I agree with you. They're all singing from the same hymn sheet, and it is tempting, but I think they're just not that smart. I don't know, Keith, maybe you disagree. You usually see things a bit more clear-eyed than I do, but
yeah, I'm more of a realist than you, Rich. No, so again, the way that we view this, the trend has been established. So the Dutch, the first they made the announcement about fertilizers, and here in Canada we've done the exact same thing. I think the Italians have as well, maybe Poland. I'm not quite sure, but it's not going to surprise me if the Canadians they try to make the same announcement as well. They want to call the herd, so to speak. So that's where we're going, and it creates investment opportunities. I was chatting with
Ice Cap Ranch.
The Ice Cap Ranch. I was chatting with a guy yesterday, and we're talking about this, and he said, "Well, can we stop it?" And and I said, "Well, you and I, we're both older, and we don't have the energy to work all day and then go down to the town square and protest because we'll get tired after an hour." The only way this changes is if the younger generations get out and they make themselves vocal. So that's you two guys, not me, because again, I don't have the stamina for it. But you get, that's how you will get change. But as of right now, I mean, get ready, guys. It's coming. It's coming right down the middle of the plate, and you know, don't foul it off.
Oh, sorry. I just want to add something that I've been thinking about for a long time, and I just think if Canadian government really genuinely, in a real honest to goodness way, cared about global emissions, the strategy should be the exact opposite. And I've been thinking about this a long time. It's the first time I've sort of fleshed this out loud with you guys. But Canada should be increasing, not decreasing, our emissions if the stated goal is to reduce global emissions. And you say, Rich, how is that possible? Canada is a much safer and better place to produce a lot of these things. That's one. And I think we do have a moral, frankly, operative to help other countries. But if just Canada were to start, for example, massively exporting natural gas in a systematic, structured, long-term way, we could basically help the world convert all of their coal-fired power plants to natural gas. It would take some time. It would take some CapEx. It would take some leadership. But by doing that, you could reduce emissions by 50%, right? Coal versus natural gas, it's a no-brainer. It's almost half as far as global emissions. So, and I mean, that's just the start of it. I mean, if Canada were to produce hydroelectric dams, we could use that energy to create, to liquefy, I think it's hydrogen, and use that to power, fleet vehicles for, certain types of companies and operations. So the idea that Canadians are going to turn themselves into a pretzel by trying to reduce emissions, I think, is the exact wrong thing we should do. Canada should use our natural resources to reduce global emissions. And by doing that, we would increase our emissions marginally. But in aggregate, which is what this whole thing is about, I could actually see a plan or make a pretty cogent, strategy for how you could reduce global emissions if Canada were to increase its emissions. And so it's a lack of leadership, intelligent in my view, and imagination that's really, really holding us back. Sorry, that's my latest rant on energy. I've really thought a lot about that, and it's a real shame that no one even suggests that as an alternative.
A lot of this was it's the private sector. I mean, like the big American oil companies, Exxon as an example, they've done more to reduce their growth and emissions output than any other entity out there. So, we all want, a cleaner environment, reduce pollution, all that stuff. And people say, well, it's not exactly that, it's a bit of a different perspective. And however, they're penalizing. Remember, the whole world is not on board with this. It's only most of the Western world.
Right.
And, they're penalizing the very entities that are innovative in those fields that can help out with this. So you are right, Rich. I mean, they could go that. Again, me being me, I'm not seeing the leadership at the political side for that to happen. So therefore, it's status quo coming up. I mean, over in Britain, they'll have a new prime minister coming up soon, and the two candidates are exactly the same. They're both apart to help create all the problems that got Bojo fired. And they're going to say, yeah, we'll make things different. So I don't know, guys. It's a pretty...
We had touched briefly on Taiwan here before we wrap this up. But I don't know. I'm not a geopolitical strategist here. We've had some conversations, the Loonie Hour being out there. We've had some interesting conversations and some connections, I think, in the geopolitics space, which I think we're quite privileged to have. But this was kind of very much, I think, foreseeable. It was more of just a matter of when, and it seems like we're escalating towards that point of, a larger war, right? I mean, we've already got the Russia-Ukraine war going on, and now China's making moves for Taiwan. So I don't know if you guys have any thoughts on this. I'm actually more curious about it from again, we talk about recessions and inflation. I mean, typically speaking, war, as we're seeing it, is inflationary. So, I mean, if this thing escalates even more, I just don't know. I don't know how this all comes comes home to sort of roost here, right? With the inflation story, you get another war, and it's going to be hard. Like trying to raise interest rates again on these debt loads when you're in a war. I mean, was it World War II, Rich, where they capped yields?
Yeah, that's 1940. Yeah, it was. I mean, that's
so I don't know. I don't know what the answer is. You're like, if I'm a central banker, I don't think any of this can be solved by necessarily hiking rates here if we're going to go through, if this war is going to escalate. But I don't know what your guys' thoughts are.
Do you want me to go? Remember, everything happens for a reason. There's no random decision taking place here. And, the head of the House, Nancy Pelosi, she did not on a whim decide, hey, let's go to Taiwan and hang out over there. Because the White House said, no, she's autonomous with her decision and itinerary, all that stuff. That ain't what happened at all, guys. It goes back to, again, that the White House and the Democratic Party, they are going to lose so many seats coming up here in a couple of months. And as I mentioned before, they've had zero success in any of these big ticket items. So last week, went the whole recession rant, and that fell flat. Like, people don't care about it. And then they said, well, again, this is me, okay? But then they said, well, let's do something else to create a distraction. They call Nancy and say, hey, we're going to send you to Taiwan, and we're going to make a really big deal out of this, which of course, this is what happened. So, and of course, the Chinese, they have to respond to that because they have their own internal domestic problems right now. I don't know if anyone has saw, the Chinese propaganda videos going out. Remember, the Americans are pretty good with propaganda, and CNN. So are the Russians. So are
the Chinese.
So are the Europeans and the Chinese. We all do it, right? Even the Loonie Hour sometimes. But she was sent over there to create a distraction because something is needed to get people away from viewing, all the bad things that are happening, economically in the U.S. So the Chinese, of course, they one of my friends, he's really close to this, and I said, are the Chinese, are they going to shoot her down? And he said, no. He said they wouldn't dare do that. He said, but after she leaves, they'll start doing stuff. So they basically they've circled the island. They've stopped trade coming in or out. You've probably been following it today.
Well, not quite. It was one product. That they banned. No, but anyways,
sand.
Well, yeah, but all the warships, like they've surrounded it's kind of tight, right?
It's getting hot under the collar.
Hot under the collar. So that's happening there right now, and everyone's wondering, what's the next move and stuff like that. But both
what is
sides
the next move, Keith?
I don't know. Again, where they pushed it. And the next move right now, both sides have won because the Americans went and landed, and they drank tea and stuff like that. And then the Americans have left, and now the Chinese, they've surrounded the island, and they're showing right now today, like they're firing missiles left and right over the island. Some are landing in the Sea of Japan and all that. They're not hitting anything. They're just they're marching down the square basically. So I suspect this will die down, hopefully. But if it doesn't, it goes to the next level. And as I mentioned before, financial conditions in China as well as Hong Kong, like it continues to go in the wrong direction. So just as the West has the problem with inflation, with rates going up and all that, over in China, they have the real estate problem taking place, which is hurting the banks. So it was a pretty big 48-hour news story. And right now, the Chinese said they're going to, they're doing the war games, I think, until the 7th of August for 4 days of this. And again, you start tuning, who knows what you're going to hit. So
they say nothing unites a country like war.
That's right.
Who says that?
I made it up,
Steve.
You made it up.
Rich's mom.
Can I make my mom? Hey, leave my mom out of it. But I want to make 2 points just on the China thing. One is a political point. I think we should be very, very careful to separate the Communist Chinese Party, the CCP, or the Chinese Communist Party, the Chinese Communist Party, the CCP, from the actual people there. I think that we need to stop treating that party, that political entity, that is the totalitarian leader of that country with kid gloves. I think we should need to stop treating them as a ally, because they're absolutely not. When it comes, whether it's solar panels, whether it's rare earth metals, whether it's the money that's infiltrating British Columbia through casinos, whether it's buying up land in Canada, or lobbying universities for this and that. I think we just need to be way, way, way more skeptical about that political entity. And the other thing I think is really, and what I think is more interesting, is the capital markets thing, which I think we didn't really touch on. But China trades at an enormous premium relative to other emerging market countries, sort of at a forward earnings discount is another way of saying it. There's this flow, there's an outflow that's starting to sort of accelerate from the equity standpoint. Keith mentioned Hong Kong. I just think it's a, I think they're not really included in the MSCI to the degree that reflects their weight in the global economy. I think that will persist. And I just think that it sort of adds to sort of the narrative of the bifurcation of the world that we're starting to watch, right? This like Chinese currency block, which includes Russia, maybe Brazil, maybe Iran, and then the US block. And I just think this is it, fellas. The rest of our lives will be dominated, in my view anyway, by this sort of China versus US. And all the rest, in my view, is details. Maybe that's a conversation for a different day, but it's just the fascinating sort of there's a financial schism that I think is sort of growing. And I think whether it's the outflows, whether it's MSCI inclusion, whether it's SWIFT, whether it's a number of different things, I think this chasm is gonna grow and grow and grow.
I'm just worried about my mortgage rate. I think that's a good place.
Wait. Oh,
Okay.
but there's one thing China could have easily have done if they're, witty. When Pelosi is, visiting Taiwan, they decided to put Xi on a plane to Cuba. They announced, hey, we're, and then see how the Americans like that. Do you know what I mean? It's
true.
And like Rich, you are right. Like something, like this can't continue. Something will happen somewhere. And I suspect some kind of a false flag of some sort will pop up.
No, come on.
Then oh boy. Rich, say recession. Come on, say it. You can say it. God. But anyway, there we go, guys. I think that's another.
Yeah, if you want to know what's going to happen, just look at Nancy Pelosi's trading account.
Oh my goodness.
Watch her
How
positioning.
are they allowed to do that? It's wild to me.
Just watch your positioning. That'll tell you what the next
tells
move
you
is.
everything what's going on. That's true.
That's a good place to wrap it up. As always, we appreciate your guys' support. One thing that we ask is that you continue to share this episode with at least one family or friend, and help us beat ArriveCan. Leave us some reviews. We need to get a few more reviews on Spotify and Apple Podcasts and all that good jazz. So as always, we appreciate your support, and we'll see you next week.